Welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have Bill Dudley with us. Hi, Bill.
Hi.
Bill Dudley is the former president of the New York Fed and is now a colleague here at Princeton. We're very happy to have him with us. He's one of the foremost experts on bank regulation, central banking, and many more things in economics. And I'm also grateful to all of you for answering the poll questions. And before we start, let's go through the poll questions. The first question was, if you look at the current banking crisis, 2023, is it similar to the S&L crisis in the 1980s? That's what 44% thought. Similar to the Scandinavian crisis in the 1990s, 3% thought this way. Similar to LTCM in 1998, that's 10%. And similar to 2007, 2008, the global financial crisis, only 2% thought this way. And none of the above thought 41%. Perhaps I've missed some, continental or something like that, or it's a totally new type of crisis. The second question was about, the current state of the crisis. Is it more like a Lehman moment? So the worst is happening now? Is it Bear Stearns and, the Lehman moment is still coming? Or is it a slowly rolling crisis which will drag on? And the answers were 3%, 19%, and 77%. So that's a little bit surprising that, most of you thought this will keep on rolling on. It will be ongoing for a while, similar to the S&L crisis, I guess, which rolled on for many years. So what banks are mostly affected with that, or what parts of the financial sectors? Smaller or mid-sized banks, that's what 65% thought. All banks, 10%, including the large ones, that's only 10% thought this way. And banks and shadow banks, that's actually what 25% thought. So most of the audience thinks it's mostly mid-sized banks and small banks. So how should we react to that? Should we have just tighter regulation? Should we fine-tune the regulation we have? Or should we just think of a total redesign and overhaul of the financial sector, like having narrow banks, CBDC, which pays interest, or other more radical redesign elements? And the answers for that was 55%, let's fine-tune the regulation. 45% thought, let's overhaul more radically. So it's almost 50-50. And finally, financial dominance. To what extent this financial instability, does it make an interest rate hike in the future or fighting inflation in the future less likely, the same, or more likely? And the answer was 63% thought it was make it less likely. 29% thought it would be the same, and 9% thought it would be more likely to fight even stronger against inflation threats. So with this, I would like to move on to Bill. So we will have a fireside chat style today, and we go through the various aspects. We start with, what triggered the crisis, what are the policy conclusions from that, and so also draw some lessons. We focus very much on the US aspects, but we might also go to Europe, Credit Suisse, and other aspects as well to have a global footprint on top of it. So let me pass on the microphone to Bill, and then we will talk back and forth. But perhaps you can outline what's, in your view, what really went wrong at the Silicon Valley Bank, perhaps also Signature Bank and other banks. What are the challenges, and how can we fine-tune and improve upon?
So what went wrong with Silicon Valley Bank? Well, a couple of things went wrong. Number one, they stretched for yield. So they got a lot of deposit growth in 2020, 21, 22. And rather than just dump those deposits into short-term assets, they decided to buy long-dated treasuries and agency mortgage-backed securities, which would have been fine if interest rates had stayed low. But when interest rates rose very sharply in 2022, they developed very large mark-to-market losses in their securities book. The problem for them was that this securities book was funded by largely uninsured deposits, and they were more vulnerable because the deposit base was highly concentrated in a relatively few hands. So people literally had hundreds of millions of dollars in deposit at Silicon Valley Bank, more than what they needed to actually conduct their day-to-day banking business. Now, Silicon Valley Bank's plan was to sell off some of these long-dated securities, take a loss, and then fill that capital hole by issuing new capital. The problem is that they basically took the loss. They sold a bunch of securities to Goldman Sachs before they actually accomplished the capital raise. And the situation moved so fast that the capital raise couldn't actually be completed. This was probably the fastest bank run in history. Literally, tens and tens of billions of dollars flowing out of the bank, on a daily basis. And while Silicon Valley Bank still had quite a bit of collateral, according to news reports, they couldn't move the collateral to the federal home loan banks for advances or to the Fed discount window fast enough to come up with sufficient cash to meet their depositor withdrawals. So they basically ran out of liquidity. They didn't have the cash to honor their withdrawals. And so the bank was closed by the FDIC as a consequence of that. So the panic spread because, whenever something like this happens, it's a big surprise to people in the markets, right? And everyone then says, wow, gee, there's more risk in the market than I thought. Let's look at other banks that look like Silicon Valley Bank. Large proportion of uninsured depositors, large mark-to-market losses on their securities portfolio or loan portfolio for that matter. And those banks then also became under stress. So that's Signature Bank, First Republic Bank, and a few other regional banks. So the run spread, and the run in some ways is pretty rational once it gets started. No bank can essentially meet all its liquidity demands if they're all presented, simultaneously. No bank can liquefy all of their assets instantaneously. So the cost of running is very low, rather the cost of staying put if you're wrong and the bank runs out of liquidity. So once it starts, the incentive is to run and do your evaluation and ask your tough questions later. So that's really what happened. Credit Suisse also failed, but for other reasons. You can think of this just as the final straw on the camel's back that caused people to lose confidence in Credit Suisse. But Credit Suisse was under great duress for many, many months. And in the fourth quarter of this year, they'd had a lot of depositor and customer outflows before things stabilized early this year. So the policy response was to try to, stabilize things by basically making clear that uninsured depositors are actually going to be protected. So what the FDIC, the Fed, and the Treasury decided to do is what's called the system.
So can I ask you before you go into policy?
Sure.
So you mentioned, this was very fast. It was much faster than previous bank runs. So that's also why they probably closed already the bank on Friday morning rather than waiting for the weekend for the Silicon Valley Bank.
Yeah, they couldn't wait to the weekend because there was no money left to pay off people. So compare and contrast the case of Silicon Valley Bank to Credit Suisse. Credit Suisse got a big liquidity line from the Swiss National Bank, and that liquidity line essentially was the bridge to the weekend. That got Credit Suisse to the weekend, and so then Credit Suisse, the Swiss authorities, UBS, all got together to figure out, all right, what we're going to do over the weekend, and a deal was announced, on Sunday. Silicon Valley Bank, there wasn't the ability to get through the weekend. So that's also unusual.
And the speed, I would like to understand the speed element because the different reasons for this speed. You mentioned that, the depositor base was very particular in very big depositors, very alert customer base.
And they all knew each other.
That was because it was the online component. But, in the 2008, we had online banking already. So how much do you touch to the new technology? And the third argument is that this depositor base was very vocal on social media and all that, and that triggered others to run.
Yeah, I think that's part of it. That this deposit base, they knew each other, they tweeted to each other, and so they weren't very they were pretty homogeneous. And so if one was going to move, then so was the next one, and so on. So that's one aspect of it. But the other aspect of it was just that the amount of uninsured deposits in this particular bank was, over 90% of their deposits were uninsured. That's very unusual. Most banks, if you have even 30% of your deposits are insured, then you have enough collateral to raise liquidity to fund off all your uninsured depositors. But Silicon Valley Bank was very unusual in the high proportion of uninsured depositors that they had. So what happened was the systemic risk exception was evoked by the regulators and the U.S. Treasury, and what that basically says is that if we think this is systemic, we have the ability to not do the lowest cost resolution to the FDIC. We can actually say, look, there's going to be other consequences of this that we want to avoid. And so in this case, they basically said, we're going to protect all the depositors for Silicon Valley Bank and Signature Bank. The problem with the systemic risk exception, though, is it's only done on an ex post basis, on a case-by-case basis. So the regulatory authorities right now are trying to like sort of communicate to people that if another bank were to fail, we would probably do the systemic risk exception again, but they can't promise it because it's got to be done on a case-by-case basis with majority vote of the FDIC and the Federal Reserve Board. So they can't sort of pre-commit to it. So that we've had this interesting dance by Jay Powell and Treasury Secretary Yellen to try to intimate that all the depositors will be protected without being able to make that really ironclad.
So legally, that's not possible to really extend a blanket guarantee to all depositors.
Yeah, you could do something ad hoc. I mean, the Treasury could take some of the money from their exchange stabilization fund and basically say this is available to backstop uninsured deposits. But I think, in this case, I think their strategy is just, we're just going to make it very clear that we stand behind the banking system and hope that people hear that as we will invoke the systemic risk exception whenever it's necessary. And in this case, it's probably necessary all the time, right? Now, the good news of in terms of what's happened is things in the United States very definitely seem to be stabilizing. And the reality is the number of banks that really were sort of being picked on is a very small proportion of the total number of banks in the U.S. and a relatively quite a small proportion of U.S. banking assets. That's why in your poll, I think it's more like continental Illinois type of situation than the great financial crisis. The savings and loan crisis is relevant in terms of like what's the cause of the initial problem. It's an interest rate asset liability mismatch. That's why the S&Ls got in trouble. But the S&L crisis is very different because most S&Ls had very small proportion of uninsured deposits. The S&Ls were able to operate even when they were insolvent because they can continue to attract deposits. And what we saw in this S&L crisis is that because of that, they took a lot of risk because it was sort of heads we win, tails the government loses. And so the fact they could operate with insured deposits, even though when they were insolvent, meant that they actually took more risk and generated even bigger losses for the federal government when they were finally wound up.
But if you say, so nevertheless, you think it's very isolated, those very specific banks, but nevertheless, it started to spread. In continental Illinois, you would say there was spreading too, so you essentially needed a blanket guarantee, or it was advisable to have an express an implicit blanket guarantee? Well,
every situation is different, but I mean, I think the key point is once one bank goes, everyone looks for the next weakest bank. And if you don't sort of make it clear that you're building a firewall between that first bank that fails and the next one, then it's going to tend to keep going because people's risk aversion goes up dramatically after the first bank has failed. So that's why it requires ever greater force to prevent the contagion from spreading once the first domino falls.
So many people focused on the US Treasuries, this sovereign, Silicon Valley Bank was holding. So the sovereign debt was, very much not marked to market. But there are also a lot of mortgages banks are holding. So if you were to mark to market the mortgages, the extended mortgages to 2.8% interest rate for 30 years, there must be huge losses on the mortgage books.
No, there are a lot of losses embedded in the entire banking business, but it's important and people have argued that the losses are, a pretty large proportion of total banking equity. But it's really important to understand that that's not the only part of the story. Mm-hmm. A lot of banks have deposits that are very sticky, and they don't need to pay market rates of interest on those deposits to continue to have those deposits as part of their banking business. So, as interest rates go up, there's losses on the securities portfolio, but the retail deposits become more and more valuable. Mm-hmm. And so you really have to net those two things together. The second thing is, banks do have franchise value. They make profits off their customer base, and that also has to be taken into consideration. So, yeah, I think that, banks' net interest margins are probably going to, come under a bit of pressure as we go forward. what's interesting in the fourth quarter, most banks, though, net interest margins actually widened. Because what happened was the Fed was raising rates very quickly, and banks were being slow to raise the rates that they pay on deposits. Now, I think what will happen over in the fullness of time, banks will have to pay more for deposits. And so eventually that net interest margin widening will probably come back down. The big beneficiary of what we're seeing right now is the money center banks, because the deposits are flowing to the money center banks. So that will allow them to be even less aggressive about paying interest on deposits. So you're going to see, I think, in the first quarter, the net interest margin for the money center banks that can continue to widen. I think will be very interesting to see is what happens to the net interest margin of some of these regional banks. So we're going to get first quarter earnings from most of these banks in the next month, and it's going to be very interesting to peruse those earning reports and those balance sheet statements to see what's happened to their net interest margin. So I think the risk is mostly past, but I'm going to be very interested to see what they report in the first quarter, what their balance sheet looks like, and whether that passes muster with investors and depositors. If we can get through that, that evaluation over the next month, then I think the worst of this has passed.
So during the global financial crisis, the LIBOR-OS spread was actually the variable to look at. What variables would you look at in the current crisis? Saying, well, that's, you just mentioned already, net interest margins. What would you look at in particular? Some price and volume data. What's really to look out for?
Well, I think, I mean, you want to look at a number of things. So number one, you're looking at how much stress are banks actually going through. So one thing you want to look at is how much money are they borrowing from the Federal Home Loan Bank System? How much money are they borrowing from the Federal Reserve, either the discount window or this new special facility the Fed is set up to lend against treasuries and agency mortgage-backed securities. So you want to look at how much are they dependent on the Federal Home Loan Banks and the Fed for funding. So that's number one. Number two, you want to look at the net interest margin. Is that being squeezed? Number three, you want to look at this loan to mark-to-market losses in terms of their portfolio. And those are things. And then the last thing you want to look at, and I think this is more about thinking about what's the impact of this on the economy, is you want to look at what's happening to bank lending. What people are concerned about this is that this turmoil in the banking sector is going to cause banks to pull back on lending, and then that's going to hurt the economy. My own view is that I'm somewhat skeptical that this is a very powerful channel, because the problem for the banks is not that they have a credit problem. They have an interest rate mismatch problem. So it seems to me that the solution to an interest rate mismatch problem is to take less interest rate risk. It's not to pull back on lending. Now, if you thought that this was sufficient to cause the economy to go into a much worse trajectory, then that would be a reason to pull back on lending. But if you think the effects of this on the economy, first order effects of this on the economy are pretty mild, which I think, then I don't really see this having a huge effect on banks' willingness to lend. If I'm a bank and the economic outlook has not changed in a fundamental way, why should I be altering my lending decisions? If it's a good loan, if I think it's a good loan given the outlook for the economy, then I should be willing to make the same loan today.
But perhaps you have less equity or less capital to.
Well, yeah, I mean, the capital is only depleted to the extent that the mark-to-market losses are occurring in the hold-to-maturity part of the portfolio. Otherwise, in the hold-to-maturity part of the portfolio, it doesn't flow through capital. So there's no immediate regulatory capital effect.
No, but do you think when banks make credit decisions or some hurdle rates decisions, they focus more on the regulatory capital or more on the economic capital through?
Well, that's a good question. I would imagine they focus on both. But at the end of the day, if you're a bank, you have customers and you want to service your customers, and the customer comes to you with a request for a loan, are you going to turn them down if you think their credit is good? It would seem to me more likely that you would basically, liquidate some of your portfolio, securities portfolio, and use those proceeds to fund loans, because you could reduce interest rate risk and you also could improve your margins. Typically, lending is going to have a higher margin than investing in treasuries or agency mortgage-backed securities. So I just don't see the logic of pulling back on the lending side of the equation.
So I wanted to ask you about, modeling of the deposit side of how stable the deposits are and how much market power the banks have. We have a lot of sophisticated modeling and prepayment risk of mortgages. Do you have an idea with the banks how sophisticated are they in their modeling and managing the deposit stability? Is there a lot of innovation in the last few years which happened, or do you foresee an innovation in this?
Well, I think a lot of what's been done is by the very biggest banks. There's a regulatory requirement called the net stable funding ratio, and it basically looks at different classes of deposits and basically, decides how, runnable they are likely to be. I mean, I think for banks, if you divide the deposits, there's sort of three buckets. There's the insured deposits that are remarkably stable. I mean, you basically can be broke and the insured deposits will stay there. Then there's the uninsured deposits that are needed for a corporation or other business to conduct their operations. So the deposits that are tied to payroll, the deposits that are tied to, paying suppliers, those deposits are pretty stable as well, because there's a big cost to a company of moving their banking business from one bank to another. And then there's the large uninsured deposits that aren't really there to do banking business. I mean, the best example of this in the case of Silicon Valley Bank is apparently Circle, which is a cryptocurrency purveyor. They have a US dollar stable coin. They apparently had several $1 billion on deposit at Silicon Valley Bank to backstop US dollar coin. The money didn't have to be at Silicon Valley Bank. It could be in treasury bills. It could be in treasury money market funds. It could be at another bank. And so that money was, immediately movable without any consequence at all. So it really depends. It's more of an art than science, I think, at this stage.
But do you think they are very interest rate sensitive in a sense, or is it more the risk sensitivity? Well, I mean, I think, retail deposits, probably have some interest rate sensitivity, right? Because obviously if the bank is paying you 1% and you get 4.5% from a money market mutual fund, that's going to affect your decision whether to keep the deposits there. Typically, though, households have not been that alert or sensitive to the level of market rates. And that's why, as interest rates went up last year, the retail deposits went from being very unattractive to banks when they have these big, deposit branch networks. They have to pay for all these branches. Interest rates are zero. Those deposit branches are just a huge sinkhole of cost. But when interest rates go up, those deposit branches have a lot of utility because they're producing a lot of low-cost deposits. So let me come back when you compared it to the S&L crisis. You said, S&L crisis, there was essentially not a bank run, and that's why the S&L crisis dragged on over almost 10 years. So are you saying actually having this bank run is shortening the length of the total crisis?
Well, I don't know about that. I would just say it's a different situation. I mean, the S&L crisis were typically smaller institutions that were reliant on retail insured deposits. And, during that period, there were also a lot of broker deposits where you could basically, take a big chunk of money and divide it up into smaller sized insured deposits and distribute them across a number of depository institutions. Then you can still do that today. And so that allowed the S&Ls to stay in business and continue to fund themselves, even when, if on a liquidation basis, they were broke. And we know they were broke on a liquidation basis because we ultimately did close down a lot of S&Ls, and it costs the government something on the order of maybe $150 billion.
So can you elaborate a little bit, what role the Fed Home Loan Bank plays in this context, also in context, then you all talk about the backstop.
They're a lot more important than people think. And they were also really important during the Great Financial Crisis. So the Federal Home Loan Bank system, there's now 11 Federal Home Loan Banks in the country. And basically what they do is they issue Federal Home Loan Bank obligations, discount notes and longer dated coupons. And they use those proceeds to basically give it loans to depository institutions. So the depository institutions pledge some of their assets to the Federal Home Loan Banks, and the Federal Home Banks have that as collateral, and they lend this money against these advances.
Do they use the
Federal Home Loan Banks are really safe, though, in terms of where they sit in the hierarchy, because not only do they have the collateral that the banks have pledged to them with haircuts, they're also senior to the FDIC if the bank actually fails. So if a bank that they've lent to actually fails, not only do they have the collateral that they can liquidate, but they're also senior to the FDIC in terms of the claim. So the Federal Home Loan Banks are pretty safe in this whole process. And all during the great financial crisis, the federal home banks stayed in business, were able to fund and provide a source of liquidity. This source of liquidity is actually more popular for banks than the discount window because it doesn't have the stigma attached to borrowing.
Why is it the case that the discount window has a stigma and the borrowing from the federal home loan banks does not?
I think the discount window has stigma for a couple of reasons. One, it's an above market rate. It's a slight penalty rate, so it's above what you can get from borrowing, in the federal fund market from another bank, or what you can get doing borrowing through the repo market. So the discount window, so if you go to the discount window, it's usually a sign that you either had a surprise at the end of the day and some payment hit your account and you weren't anticipating it, so you just need to borrow a little money from the Fed to tide you over to the next day, or a sign that you're in difficulty, that you're having trouble raising money from other banks or from your customers. So banks are pretty allergic to relying on the discount window very heavily. Although you can see in this last episode, discount window borrowings did go up quite dramatically. This is an example where, if you really don't have the money from any other source, if your choices are to fail or borrow from the discount window, of course you're going to go to the discount window in that case.
But the Federal Home Loan Bank is lending at what rate? At the policy rate?
It's basically, the cost of their advance plus a little bit of markup. So you can think of the Federal Home Loan Banks are borrowing at the Treasury market rate plus just a small little premium above that. And then they're lending at a markup above that. The other advantage of the Federal Home Loan Banks is they can also advance you term lending. So it doesn't have to be an overnight loan. It could be a term loan. So the banks are just much more comfortable with using the Federal Home Loan Banks. This has been, they've been using them on sort of a regular basis. So that's something that they're pretty comfortable with.
But as a depositor, I should become even more concerned because I'm actually junior.
No. But you're not. But the FDIC is protecting you, so you don't need to worry about that. I mean, the FDIC is backstopped by, not only is it backstopped by the fact that they can assess more insurance premiums against the banking industry to rebuild the reserve fund. They also have a line of credit to the U.S. Treasury. I cannot imagine a circumstance in which the FDIC fund didn't make good on its obligations.
So if you look at this new Fed backstop liquidity facility, if they would not have lent at par, they would not have been able to compete with the Federal Home Loan Banks.
Yeah, the attraction of it was that I could bring in a security at par that's only worth 80 cents to the dollar and get $1 for it. So, that's useful if you have a shortage of collateral. Mm-hmm. But most banks that have a large proportion of insured deposits have plenty of collateral because they don't have to collateralize their insured deposits. So let's imagine my bank that's 50% insured deposits, 50% uninsured deposits. I have 100 cents of collateral to collateralize that 50% of uninsured deposits. So most banks that exist have plenty of collateral to pledge. I mean, the discount window takes a very wide array of collateral. The Federal Home Loan Banks, it's narrower, but there's plenty of ability to liquefy your portfolio at the Fed if you need to.
So why is there no stigma attached to this facility compared to the discount window?
I guess it's because it has some attractive features that I can borrow $1 against, 85 cents or 80 cents. So, I think, things are not stigmatized that look attractive, right? So if I offer a facility that makes sense from a market perspective to use, then people are going to use it. I mean, a good example of this is the reverse repo facility that money market funds use to take their cash and deposit it, take their cash deposit do repo with the Fed. They do it because they're getting a better rate than if they did repo in the private market. So if the facility is attractive on the face of it, there's really no stigma attached to it.
So is there some risk for the Fed essentially? Because some people argue, if there's a default, let's suppose this collateralized treasuries.
Yeah, a little bit.
The Fed takes it for 100 cents to the dollar and then just sits on it till it matures.
Well, there's a little bit of risk, and the Fed has recourse to the lender, borrower, and they also have a bunch of Treasury money that's been given to them from the Exchange Stabilization Fund as a first loss piece. So basically, what has to happen is a bank would have to fail. The Fed would then have potentially have some losses on because the collateral would be worth less than what the Fed lent to them. And then the Exchange Stabilization Fund equity tranche would make the Fed whole. So that's why this is a 13-3 facility. That's why the Treasury was involved. And that's why the Treasury made the equity contribution, so the Fed could actually take this risk.
Perhaps you can explain to the audience what 13.3 facility is, or I thought it was almost eliminated during Dodd-Frank. That was one of the...
Yeah, so 13.3 facilities are a facility that can be introduced only after the Fed determines that we're in a situation of unusual and exigent circumstances, and when certain classes of borrowers can't get funding from any other source. And in those circumstances, with the agreement of the Treasury, the Fed is allowed to set up broad-based facilities to support the financial system. What was taken away with Dodd-Frank is the ability to offer a facility to support a single institution. So the Fed can no longer have a facility to support, for example, AIG. So it has to be broad-based. And that's what's different. That's what was taken away from the Fed by the Dodd-Frank Act.
And how big is this Exchange Stabilization Fund? Somebody asks in the audience.
Yeah, I'm not sure what the limit is. I mean, I can't remember the exact amount that the Exchange Stabilization Fund pledged. I think it was something on the order of maybe 25 billion. I think the Fed has to make a judgment of how much equity can that support safely, and so I imagine it's probably pretty elastic. I'm not worried about the Fed running out of capacity there.
So is this, if you take all of this discount window, federal home loan banks, this new facility, I think there's important pieces missing?
Well, I mean, the main struggle that both the Treasury and the Fed have had are the uninsured deposits protected ex ante? Mm-hmm. And they've been saying things like, we think all deposits in the banking system are safe, or all the deposits in the banking system will be safe. But they can't be quite as explicit as they'd like to be, because to be truly explicit, you have to basically say that the systemic risk exception would be invoked in every case. And they're just not quite comfortable, moving that far. Now, I mean, Treasury Secretary Yellen has been very clear that if things got worse, we'll escalate. So that's another way of reassuring people. Mm-hmm. So I have no doubt that if things were to get worse, we would see more action by the Treasury and the Fed. I don't expect things to get worse. So I don't expect that kind of.
If you ever were to extend a blanket guarantee, would you then only for a limited time frame extend it, or would you specify the time frame, or would you say there's
an explicit blanket guarantee would have to be done by Congress. Congress would have to enact it. That's the catch right now, and Congress doesn't seem to have the functional ability to agree on much of anything at this point. So I can't imagine that coming forward. I mean, from Congress at this point. But the Treasury still has the Exchange Stabilization Fund monies, and that could still be used. The Fed still has the ability to escalate in terms of the discount window. They could offer term funding. They could do, a term auction facility like they did during the Great Financial Crisis. So there's still definitely escalation options available. The toolkit's not empty at this point.
Can you outline a little bit the moral hazard considerations? If you extend the blanket guarantee, do you think all the debt will then convert to deposits essentially in order to?
Well, it does create a lot of issues. So if you were to be very explicit that all the deposits are protected, then you're creating a much bigger pool of safe assets that's elastic, that people can float towards. Mm-hmm. And so that's going to disadvantage assets that are, don't have that protection. Like think about, A1, P1 commercial paper. So presumably what would happen is the spread between A1, P1 commercial paper and uninsured deposit rates would probably widen a bit. So you have to be a little bit cautious about when you make these kind of blanket guarantees, because you are going to create, boundary issues in terms of where's the boundary between what's insured and then what's the next thing.
So let me talk a little bit about the interaction among the banks, because what you see fund outflows, deposit outflows from the smaller and regional banks towards the big banks. Of course, if you have a well-functioning banking system, the big banks could just rechannel it back to the regional banks, and then the funding situation would be resolved. And we saw it to some extent, where the JP Morgan and Bank of America and Citibank actually channeled back to First Republic Bank, of course, at a much higher interest rate than the initial deposits probably were charging. Do you think that if the banks themselves could stabilize themselves much more by, channeling it bank, or do you think the interbank market is working well in this regard?
Well, I think one of the constraints here is the supplemental leverage ratio, which basically puts a limit on, the ratio of total assets in a bank and its equity capital. And so, to the extent that more deposits move to money center banks and they lend out those deposits and expand their balance sheet, then there's a risk that the supplemental leverage ratio becomes binding for those banks. And the banks also may not, always feel comfortable with the counterparty risk of having large exposures to banks that, could potentially be at risk. So it's not the greatest recycling mechanism. Another problem we have compared to 10 years ago, it used to be that the money market funds played a lot of this recycling mechanism. We had very large prime money market funds that invested in bank CDs and banks commercial paper. And when we reformed the money market fund industry by introducing floating NAVs for institutional prime money market funds, that basically made that whole industry go away. And so the prime money market fund industry today is much smaller than it was, a decade ago. And so that's not available as easily as a recycling mechanism.
Should we rethink the regulation to, make
definitely not. The money market, we've had a couple episodes of money market fund turmoil. I don't think we want to go back to that.
Okay. Good. So perhaps we can go to further policy measures. Then we touched already on many of these, and also the implications for monetary policy.
Yeah, on the monetary policy side, if I may, I think that the big issue here is going to be the question of how much do these banking woes actually restrain economic growth. The Fed, prior to the Silicon Valley Bank problems, the Fed was basically determining that interest rates were not sufficiently high enough to restrain the economy fast enough to get inflation back down to 2% in a timely way. I mean, when Chairman Powell mused that maybe we need to consider moving back to 50 basis point rate hike, it was really because of the economy in the first quarter looked to be considerably stronger than what the Fed had anticipated. And so the Fed was rethinking what moderately restrictive meant in terms of the level of short-term interest rates consistent with moderately restrictive. Now, what's changed is we now have these banking system problems, which are going to exert some restraint on growth. And so now the Fed Reserve is, essentially has to estimate how much does this replace or substitute for further rate hikes. And the answer at this point is we just don't know. If the contagion ends and it's all just a few banks, then the effects on the economy are likely to be very, very modest. And then the Federal Reserve is probably going to have to return to raising interest rates further. In contrast, the banks, respond to this shock by pulling back credit availability in a significant way, then the Federal Reserve might be done. And the reality is we just don't know. So
what variables do you look at?
Well, I'm going to be looking at loans outstanding. I'm going to look at the senior loan officer survey, which talks about the credit standards. I'm going to be looking at the real economic data in terms of seeing what's happening to economic activity. The Atlanta Fed has a Fed now GDP has a GDP now forecast, and I'm not sure where it is today, but I looked earlier in the week and it was at 3.2% for the first quarter. I mean, the Fed is still in the same place they've been at for a while. Economy is too strong, labor market's too tight, inflation's too high. And in some ways, they're actually in a worse situation now because they have a lot more uncertainty about the trajectory of growth because of these banking system woes. And so this is going to make it harder for them to determine what's the appropriate approach, the best approach.
I think the situation is now much more non-linear, like, you can't control it. It might be jumping rather than smoothly going down as you type.
Yeah, I think it could be. I mean, obviously banking system, stresses can go, from mild to fast very, very quickly. But I also think it's just like, you don't really know how big the impact of this is going to be. And so, whatever you thought before, the uncertainty bands around what you thought before have just gotten a lot wider. So think of it as before the Fed was sort of conducting policy with a well-functioning banking system. They sort of knew how the transmission mechanism of monetary policy works. And now they have a slightly impaired transmission mechanism, and they're not really sure how impaired it is. And so what the consequences of that are going to be for the real economy. So they're just a little bit, before it was sunny out, and now it's raining, and so they're sort of driving through the rain, and so they're a little bit less certain about, where they're going and how fast they can drive there.
When the other thing you saw, even though the Fed tightened by 25 basis points, the long end of the Treasury yield came down. And I don't know what the mortgage market did. It probably came down a little bit too. So it's not really a tightening on the long end.
Yeah, although in the last few days, the long end is going back up. I mean, what's essentially been happening as sentiment about the banks has improved, people are now starting to price back in more monetary policy tightening. And as a consequence of that, long-term rates are also moving up again. So, right now, I mean, I looked just before we got on, it looks like the markets are 50-50 in terms of a 25 base point hike at the May meeting. So, if the banking system improves, people will assume that there's less restraint. If they assume there's less restraint, then there's more for the Fed to do. So we'll see.
So, the president of the ECB, Lagarde, said you can actually separate totally liquidity tools on financial stability and monetary policy tools to do inflation. Do you believe that you can totally separate these two things? They can be, very accommodative for financial stability, but very restrictive in monetary policy terms? Or do you think these two components are interacting?
I think it's largely true. I think it's largely true that you can separate them. I mean, you basically have liquidity tools to deal with financial stability issues, and then you have the interest rate tool to deal with, strength of the economy, inflation. But there is a but. The higher you push short-term interest rates, the more stress you're putting on the banking system, and the more, risk you have on the financial stability front. So the two, you have tools to address each of these pieces, but the pieces are not completely separate. The monetary policy I pursue will affect the degree of financial stress I'm putting on the banking system. So they're not completely separable.
So do you think it's the level of the interest rate which causes the troubles, or is the speed of the?
Well, look, I think it's probably both. But clearly, if the Fed had tightened sooner and had been more gradual, I think we would have less stress. This was one of the most rapid tightenings in Fed history. They raised rates by 4.5 to 4.75% in 9 months. And I was a little surprised as we went through that process that we weren't seeing more signs of stress, because the last time we did this in 1994, Orange County went bankrupt. So I was expecting there to be other, casualties. And there basically were no casualties of note until Silicon Valley Bank. And Silicon Valley Bank, ironically, was completely avoidable. All they had to do was not take the interest rate risk in the first place, or if they took it, raise the capital first, and then sell off the securities. So I know the regulators are getting a lot of flack for what happened at Silicon Valley Bank, and I think it's fair to say that the regulators probably should have moved more forcefully in forcing the bank to deal with their interest rate risk. But at the end of the day, the number one culprit here is the management of Silicon Valley Bank. They didn't need to do this to be a viable bank. They had a good franchise, and they blew it up because they were greedy. They were trying to stretch for a little bit more yield because they wanted a little bit more profits, because they wanted a little bit stronger stock price, and that greed cost them their bank.
So can we talk briefly about the interest rate swap market? So typically it's a case that the smaller and regional banks, they buy protection from the big banks on the interest rate swap market. They didn't buy enough this time around, or what went wrong on the interest rate swap market, or not on? Why didn't they make use of it? Let's put it this way.
Well, I mean, if you're using the swap market to, reverse your interest rate exposure, then you're also eliminating the profits from that exposure, right? Because you're essentially swapping long dated fixed assets back into floating rate. So Silicon Valley Bank could have hedged their risk. They could have hedged their risk. They chose not to. And because they chose not to, that's why they had such a big exposure. So that was a choice they made. But clearly there's plenty of tools out there that allow you to hedge your interest rate risk, both by using swaps, but also by using swaptions. You can take you can also buy out of the money protection. So, the problem with the disincentive to doing so is that using those things does cost you, profit margin in the short term.
So would you say actually what we observe that typically, or in ideal world, the smaller and regional banks buy protection against interest rate movements from the big banks makes sense because the big banks have this too big to fail benefit that the deposits fly into the big banks, and this way they can easily provide this interest rate insurance.
Well, I don't know that they have to buy it from the big banks. I mean, they just have to buy it in the capital markets. I mean, there's a lot of people that sell interest rate swaps. So I don't, it's really more of a securities business than a banking business. Look, I don't think the big banks, think about, oh, we're gonna just sort of sell these swaps to the smaller banks. There's a market for swaps. There's a big, deep, liquid market for swaps, and the big banks are participants, and medium-sized banks are participants. But I wouldn't view it as quite so. One group of players is selling swaps to another group of players. It's going lots of different directions.
I mean, there's some research which shows about Monica Piazzisi and Martin Schneider shows that actually the big banks sell interest rate protection to the smaller banks.
Yeah, I mean, I think what happens in the banking market is the big banks, their business model leads to less interest rate exposure in terms of asset versus liabilities. They have less interest rate risk just by pursuit of their business. A lot of their business is business lending, floating rate business lending, and so they don't have a lot of. I mean, generally, higher interest rates for money center banks is typically a good thing, not a bad thing. But for regional banks, they have more of a consumer business, and so they often have, and they also sometimes have a abundance of deposits. And so what do we do with the extra deposits? Well, we make loans with some of them, but then what do we do with the rest? Well, they can dump that into longer dated securities because they hope to earn a higher return over time. Now, the problem with long dated securities over the last decade, as you know, Marcus, is there's been no positive risk premium from holding a long-term security versus a series of short dated obligations. So you really haven't been paid to invest in longer dated assets. And I'm surprised that banks haven't sort of reflected that in their asset liability management.
So can I ask you something right now for the Silicon Valley Bank, essentially, the FDIC made some losses, some significant losses. Can you explain to us, how these losses will be spread? The FDIC probably will increase the fees on the rest of the banking sector.
Yeah, that's exactly what will happen. I mean, this is just another example of a bank alive is worth a lot more than a bank dead. Once a bank fails, the franchise value gets eroded. A lot of the value of the bank in terms of its software and technology becomes outmoded. And so, there's a big jump in deterioration of value when a bank fails. Now, in the case of Silicon Valley Bank, that jump was probably exacerbated by the fact that they had a pretty unique banking model. And there probably weren't a lot of banks that were comfortable, taking on board that different banking model. The other thing that I think made it a little bit more difficult for the FDIC in this cycle is the large banks have much less appetite to buy smaller banks now than before for three reasons. Number one, the regulators don't want the big banks to get bigger. Number two, the big banks, when they bought firms that failed last time, assumed a lot of legal liabilities that they didn't anticipate, and they had very bad experiences doing so. Ask Jamie Dimon, for example, about how he feels about his acquisition of Bear Stearns and Washington Mutual. He would never do either of those again. And the last reason why large banks don't want to buy smaller entities is the way their capital regime works. There's buckets for what's called the SIFI surcharge, the systemically important financial institution surcharge on capital. And if you get bigger and more complex, you move into a bigger SIFI surcharge bucket. And that increment of capital doesn't apply just to the assets that you just acquired. It applies to your entire book of business. So let's imagine JP Morgan, $2 trillion bank, buys a $200 billion, makes a $200 billion acquisition, and it has to pay, and that pushes them into a higher SIFI bucket of 0.5%. That 0.5% additional capital charge applies not to the 200 billion, but to the 2.2 billion. So very, very expensive for them. So there's a huge disincentive to get pushed into the next SIFI bucket. So this time you didn't see the big banks do the acquisitions. That's another. So I think the pool of potential buyers for Silicon Valley Bank was much smaller, and that's why First Citizens Bank looks like they got a very good deal on their acquisition, because you can see what the market assessment was after it was announced. First Citizens Bank's stock price went up very sharply.
I see. So perhaps I can go a little bit, how should we change the regulatory framework now and the supervision, given, should we really have some different rules on interest rate risk and, push the banks to be faster and more aggressive in their risk management approach?
I think there's a number of things. So this whole hold to maturity idea of securities. Right now, if you can basically claim that a given amount of securities that you hold are in the hold to maturity bucket, and the hold to maturity bucket means that mark to market losses just sit there. They don't flow through your equity capital. They don't affect earnings. So, and that's independent of how you're funding those assets. So you need to have a better linkage between the hold to maturity assets and how they're funded. So that's number one. So the asset, you have to look at both sides of the balance sheet. Number two, I think you just have to look at what's the interest rate exposure of the bank. If interest rates go up a lot, what's going to happen to the bank in terms of their net interest margin, in terms of the capital losses that they're going to be booking either on their hold to maturity book or their available for sale assets. So I think that's going to happen. The second thing I think is going to happen is the regulators, I think need to move faster and more aggressively when they identify problems. So according to Michael Barr's testimony to Congress this week, he made it very clear that the Fed examiners were on the case at Silicon Valley Bank. They had identified, some of the interest rate mismatch issues, and they had basically, told the manager that you got to fix these. But the problem is that typically what happens is the regulators give the bank some time to do so, and the bank can drag its feet, and there can be multiple iterations before the Fed gets angry enough.
Was it the San Francisco Fed in charge? Who decides to close down? So the ultimate threat point is to close down the bank, but you
can do things. You can do things less punitive than that, though. You can issue enforcement orders. You can force the bank to raise more capital. So I just think that the regulators are probably going to have to look at, when we see something that we really don't like, we need to increase not just the size of the penalty of the bank, but also the tempo. We have to move to be more aggressive quicker. Third thing that's going to happen is the Fed almost certainly is going to move back down and make that threshold for tighter regulation 100 billion. So what happened in 2018 when Trump administration passed legislation which basically raised the threshold for systemic bank regulation from 50 billion to 250 billion. And at the same time, the new legislation basically said the Fed had the discretion to have higher standards all the way down to 100 billion. And the Fed said, no, we're not going to do that. We'll just be at 250 billion. Fed will now use that discretion. I'm almost certain that 100 billion will be the new threshold for the Fed.
So no law change is required. The Fed can do this.
No law change is required for that. Another thing that I think will happen is systemic risk testing will be a little bit more varied. So one of the complaints of the Fed's stress test that they use for what's called CCAR process, where they're assessing banks' capital adequacy under stress, was the stress test this year was interest rates stay low for a very extended period. The economy is really weak. Well, that wasn't a very good description of what actually happened. And so the stress test was very ill-suited to identifying capital weakness in the case of a bank like Silicon Valley Bank. So I think we're going to need to have stress tests that encompass a broader array of possible surprises, and so I think that'll be coming.
You're arguing for more than one stress scenario, so you won't have
exactly. Now the uninsured deposits is tricky, right? The current regime is pretty inefficient, right? To basically insure the deposits after the fact is responding after the horse has left the barn. And it's also a bit arbitrary and unfair because, some banks will have their uninsured deposits protected and potentially other banks might not. So that might cause you to say, well, let's just insure all the deposits. But if you insure all the deposits, then you're going to have all sorts of moral hazard issues, just like we saw with the savings and loans. So the question is there a middle ground? And I think there probably is. I can imagine protecting all the uninsured depositors, but only with constraints on the banking's book of business. If you look at the banks that get in trouble, the banks that get in trouble typically are fast growers with sort of pretty unique business models and concentration of exposures. So let's imagine we sort of had a regime and said, we'll protect all depositors as long as you're not growing really fast, and as long as you don't have, big mark-to-market losses in your loan book, a whole host of criteria. You could probably do it in a way that you basically, bailed in like 95% of the banking institutions, and you created incentives for the 5% that were outside to behave in a better manner. So there might be, it doesn't have to be either, uninsured deposits have to persist or all deposits have to be insured. There might be a middle ground here. I think this needs to be explored because I do think this idea of doing it on an ex post basis is really messy and potentially unfair.
But you're fine with making it more complicated and complex, because if you have all this conditioning, it will be a more complicated regulatory framework too.
Yeah, but I think you could do it. You could just have some thresholds where if you go past this threshold, you no longer have insurance for all your uninsured deposits. And I bet what would happen is banks just wouldn't go past that threshold anymore. Yeah. So you'd sort of like put speed limits in on bank behavior. And you look at Silicon Valley Bank; they more than doubled their asset size in a couple of years. So let's imagine Silicon Valley Bank just had to grow a lot more slowly. Would they have all the assets that they were going to dump in these long-dated treasury and agency mortgage-backed securities? They probably wouldn't have had the assets, and so they wouldn't have taken on the interest rate risk, so they wouldn't have gotten in trouble in the first place. So I think some sort of you'd have to do a lot careful study of this. Basically, think about like what causes banks to get into trouble, and so what do we want to do to prevent those kind of behaviors? And we prevent those behaviors. The other thing I'd like to see is change how we compensate bank CEOs. Right now, we pay them with cash and equity. And I think paying them with equity encourages more risk-taking. I'd love to pay them with subordinated debt that goes away if they fail. I think if they were paid in compensation that they had to hold for many years, that vanished if the bank failed, I think they would take a lot less risk. So I think there's also
some clawback provisions.
Well, just subordinated debt. If at the holding company level, if the bank fails, the subordinated debt goes to zero. End of story. So this is, think about how the old investment banking partnerships worked. They had unlimited liability. The partners had unlimited liability. So if the partnership failed, the partners were on the hook for not only the capital they contributed to the partnership, but to their own net worth. So that made the partners a lot more risk averse in terms of taking risk. We talked about looking at compensation after the GFC, and then it just sort of died out in the United States. I think compensation is another new, an area to take another look at, frankly. And then the final thing I think is interesting about this whole thing is, and this comes back more to Credit Suisse and UBS, the Swiss authorities decided not to take Credit Suisse into resolution. They said it was just too big and complex. And the issue here is if very large, systemically important financial institutions are too big and complex to be resolved, it raises the question is, why do we have this whole resolution framework? If it's not workable, then living wills and all the things that we built to allow a large systemically important bank to be resolved, all that's called into question. So I think the decision of the Swiss authorities to arrange a forced merger between UBS and Credit Suisse really calls into question, is this resolution framework really credible? And if you're not willing to use the resolution framework, what you're basically saying is that the biggest banks are still too big to fail. And right now, we're seeing a distortion in the banking system. Money is moving to the biggest banks, and that's also not a very desirable attribute. You don't want the biggest banks getting bigger just because they're viewed as too big to fail. So that's something I think we need.
But are you saying the whole debate and about too big to fail, we haven't resolved the issue essentially?
Doesn't seem like it yet. Now perhaps the United States could take a big siffy and through resolution. But the problem with these global banks is they operate in many different geographies with many different regulators, and so resolution is not straightforward. And typically when banks get into difficulty, there are other banks that are also weak at the same time. If a bank, I think resolution would work for a bank that was completely idiosyncratic. In other words, no bank looked like it at all. But typically when banks get into difficulty, there's usually other banks that have engaged in similar business practices. And so, there's correlation across the banking system.
So in Switzerland, for Credit Suisse, they had to change the law in order to avoid a vote among the shareholders. How is it in the US? Is there some prompt corrective action that you can just essentially close down even a big bank if you wanted to without the vote of the shareholders?
I'm not sure actually the answer to that with how legally it works. I think it's very similar though that the regulators decide that the bank is no longer viable, and then have the ability to put it into resolution.
The other thing which is discussed a lot,
the shareholder vote in this point in the Swiss case is different. This is a merger, right? So yes. What was unusual was about having a merger without having to wait for the shareholder vote. In resolution, you don't have to have a shareholder vote. The bank has failed. So the shareholders don't have anything to say about it at that point.
And the fact, you use the COCOs, normally the COCOs, there's a trigger and then you convert them to equity and then they will be treated like any other equity and they decided to just wipe out the COCOs. How big are COCOs for the US banks?
Virtually, it's not used in the United States.
It's the European thing.
At all, it's a European. The other thing here is people completely misunderstand what happened with the Credit Suisse AT1 capital. You can go to the Credit Suisse website and read the terms and conditions about their AT1 and COCO obligations. And what they say very clearly is that if the regulators make a finding of non-viability, which is what the regulators made a finding of, the COCOs convert not to equity, but to zero. So every AT1 can be different. So a lot of AT1s convert to equity, but these COCOs don't convert to equity, they convert to zero. So I think what happened in this case was the AT1 holders, thought that they were senior to the shareholders, but it turns out in one particular case, they're not. When they're not, when the firm is no longer viable and the government's arranging a forced merger. So it wasn't a situation that was anticipated, but based on the language in the instruments, it seems like everything happened exactly the way it was supposed to.
So you don't anticipate a long lawsuit over years?
Well, there may be a lawsuit, but my reading of the instruments is they're very clear, very clear.
So typically what we see in the US is essentially a lot of difficulties at smaller banks, and then the big banks, the too big to fail banks, benefit from capital. But here in Switzerland, you have a big bank. Do you see there's between small and big banks some shift? And also there's some talk about Charles Schwab, and do you think investment banks and brokerage houses, are there similar problems because of interest rate moves, or these are different problems?
The interest rate risk really depends on the specific institution in terms of, did they decide to invest, surplus deposits in long-dated fixed income assets, and did they decide to hedge that exposure or not? That's a choice. So there's nothing particular about Charles Schwab position that means that they're more vulnerable. They're more vulnerable if they make particular sets of decisions that put them more at risk. So I don't think there's anything. I think the banks that are more vulnerable are the ones that just have a higher proportion of uninsured deposits, because the uninsured deposits are at greater risk of runs. So a small community bank that has mostly retail deposits, there's no run risk there.
We didn't talk about cross-border issues at all. Is there any implications for cross-border issues as well from the recent events? Or?
Well, I think that the global authorities were pretty happy to see the UBS Credit Suisse merger take place. Let's put it that way. So I think there's close
pressure by the US.
I think there's close coordination, of the Swiss authorities with governments around the world telling them what they're doing, why they were doing it, and I think generally, regulators around the world were, I think probably happy to see it resolved in this way. I would suspect.
So perhaps we can, come at the end. What we touched upon it already. Does contagion stop? What's your outlook? What do you watch? And I think you have a very, less pessimistic view. You hope that the worst is over by now, or?
Yeah, well, I'm going to be very interested in the first quarter earnings of some of these regional banks, right? So in the next month, we'll get first quarter earnings reports. And so we'll be able to look at their net interest margin. We'll be able to look at how much money are they borrowing from the Fed. We'll be able to look at, things like, what's happening to their loan growth and their profitability. So I think the first quarter earnings of the banking industry generally is going to get a lot of scrutiny this quarter, more scrutiny than typical. So I think that the net interest margins are going to be very, very important to watch. If they continue to widen, which is what's been happening for the money center banks, that's going to make people feel more comfortable that the banks, it's not just about mark-to-market losses on the asset side. You have to also look at the benefit of having lots of retail deposits that you don't have to pay market rates for. So survey of senior loan officers to see how much tightening there is of credit conditions, and just to see how households and businesses think about all this. Are they scared about what's happened in these banks, or do they just view it as sort of a isolated incident that doesn't affect their behavior? You always have a question in these kind of episodes. What happens to animal spirits? Do people get unnerved by this? And if they're unnerved by this, do they pull back? And then can that be just sort of a self-reinforcing negative dynamic? I'm not planning to change my own behavior. I don't know about you, Marcus. So this doesn't have any effect on my spending decisions.
You talk about consumption, investment decisions.
Yeah, consumption, investment. Yeah. So I wouldn't think that this is enough to really affect business and household confidence in a way to affect what they're planning to do going forward. But you never know, because it is a shock.
So we talked a lot about these shocks. We didn't talk about commercial real estate. Are you worried about commercial real estate having some problems there too, or?
Oh, for sure. I think commercial real estate, especially office buildings and, in big cities that those office buildings are not being utilized to the same degree as they were before. But the good news on commercial real estate is the problem is really more when the loans come due and have to be refinanced. And the buildings are maybe no longer worth what the original loan amount was, or the bank wants more collateral than what the lender can present. There's not very many loans coming due over the next year. It's on the order of maybe 140, 150 billion dollars. So the rollover risk is quite low. So it's very possible that some of the values on these commercial loans have come down, of the commercial real estate have come down, but it's likely that people will stay mostly current on their loans, and since they don't have to refinance the loans to any great degree this year, I think it's not a positive for the banking system, but it doesn't seem to me to be something that's going to generate a real systemic shock in 2023.
So I think commercial real estate is less of a problem because most of these loans are floating. But
also the maturity. But the maturity is not coming due this year. It's really that rollover risk. So let's say I bought a building at 100. I borrowed $80 against it. As long as the rents cover my interest payment, I'm going to keep paying money on the loan. When the loan comes due, let's say the value of the building is 70, my loan is 80. The bank is now going to say, I'm not going to give you 80 anymore. I'm going to give you, 55 against the loan, and then that's when you have a problem.
So normally we stop with a positive note, but let me just ask one more question. What keeps you up at night, in a sense? Is there anything particular to say, okay, that's...
the debt limit ceiling keeps me up at night.
Yes, actually, it was a question.
I'm really worried about that because the House Speaker, Kevin McCarthy, depends on remaining House Speaker on the basis of a few extremist House Republican votes. And so if he brings to the floor legislation to raise the debt limit ceiling, I worry that he'll be at risk of losing his speakership, and I worry as a consequence he might not be willing to bring that to the floor in a timely fashion. So his vulnerability, his exposure as speaker makes me particularly worried about this particular debt limit situation.
And you don't think the Fed can solve this with a platinum coin or at?
I don't think the Treasury, it would be the Treasury's decision to do a platinum coin. What happens is the mint issues a platinum coin to the Treasury. The Fed then gives the money to the mint. The mint is allowed to turn over any extra money it has to the U.S. Treasury. Doesn't count against the debt limit. That's the loophole, but they're not going to do it. It's a loophole. It's not the intent of Congress. I mean, I just be subject to litigation almost certainly. They're not going to do that. So
can you outline the scenario? So if this were to happen, what would happen?
What would happen is two things. The day of, when the debt limit actually became binding, the government would run out of cash inflows to pay all its obligations. So the government would, essentially be receiving 60 cents every day, and they'd have like $1 of obligations.
And it wouldn't pay the congressman's salaries either.
No? So what the Treasury would almost certainly do is they would basically prioritize payments on interest and debt to avoid a government default. But they would not be able to pay a whole bunch of other things because they just wouldn't have the money to do that. And so it would be an immediate and sharp tightening of fiscal policy, probably to the tune of 7 to 8% of GDP. So it'd be a sudden stop in terms of fiscal policy. Number two would be a market cataclysm, because the markets are going to be expecting the debt limit ceiling to be averted at 11:59 p.m. So if it doesn't happen, there'll be just a huge jump in people's assessment of risk, and markets will go down dramatically. So you'll have two big problems: market turmoil and extraordinary fiscal tightening. Not a good look. Now, I don't think you can live in that environment for very long. So I think eventually cooler heads would prevail and would raise the debt limit ceiling. But it'd be much better to raise it at 11:59 or even maybe at 10 p.m.
What would it do to inflation?
It'd be a negative shock for the economy, for sure. I mean, because
but it could also be a stagflation, or do you think it would bring inflation sharply
down? Well, it
depends
what happens to the U.S. dollar. I mean, the inflation impulse would really come through the U.S. dollar, I think, not anywhere else. I think it's really basically just a very near-term big contractionary force on the economy. But it's really just a mess. It's the way I would describe it. Who knows exactly what would happen? We don't want to. People who in the House who say, well, how do you know it would be bad? I don't want to test that proposition. But
it might be the same as in 2008. If the market totally tanks, then Congress comes together just an hour later. No, it could be like the first round of TARP legislation. The first round of TARP legislation didn't pass, but that was not a pleasant experience. Yeah. So I would prefer to avoid that. So what's the positive note we're ending up with? Well, the positive note is that the economy is still in pretty good shape. Fundamentally, household and business balance sheets are in pretty good shape. And so even though the Fed still has some work to do in terms of tightening monetary policy, getting inflation under control, once they achieve that objective, I think they have the ability to reduce rates and the economy will come back pretty quickly. And what's different this time is the Fed has plenty of room to stimulate the economy. So, this whole risk of being pinned at the zero lower bound, being stuck in a Japanese style experience, that risk is really, fallen away considerably. So I'm thinking most likely a scenario in the next year is we'll probably have a mild recession. And then once that happens and inflation comes down, the Fed will relent, but then we'll have an economic recovery. And I think that's what the stock market senses. That's why the stock market is, I think, held up pretty well, even with a lot of bad inflation news and even with this turmoil in the banking system. And your inflation forecast in this scenario would be? I think it's going to come down, but slowly. I'm sort of with the Fed. I think, it's going to take time. Fed's got to generate more weakness in the labor market. It's got to bring down wage inflation. It's got to bring down services inflation. The Fed has laid it out very clearly what they need to accomplish. They need a moderately restrictive monetary policy that generates slack in the labor market. That slack in the labor market brings down wage inflation and brings down services sector inflation. And eventually we get back to 2%. So if you assign a probability between soft and hard landing?
I think hard landing is more like much more likely, because every time the Fed has generated a 1%, 0.5% rise in the unemployment rate or more, we've always had a hard landing, 12 for 12 since World War II. The Fed has said that they think they need to generate a rise in the unemployment rate of at least 1 percentage point. We're also flying a little bit more blind now with all this banking system, noise. So I think a hard landing is more likely than not, but probably not right away. I mean, the economy still is doing pretty well. I mean, just because we're going to have a hard landing, most likely doesn't mean the hard landing has to happen soon. So it could be that hard landing is, late 23, early 24. It doesn't have to necessarily happen immediately.
Very good. Thanks a lot, Bill. It was extremely insightful, and I learned a lot, and so did our audience. We're very grateful for all your statements and pointing out all the weaknesses and all the things we have to do. So thanks again, and I see you around.
Okay, thank you.
Thanks to everybody for joining us, and hope to see you soon again. Bye-bye.